The Reserve Bank of India on Thursday decided to keep the key lending rate unchanged at 4% amid rising inflation worries and a subdued economic outlook.
At the end of its deliberations, the MPC voted unanimously to leave the policy repo rate unchanged at 4%.
The Apex Bank continued with its accommodative measures to revive growth while ensuring inflation remains in check. The reverse repo rate also stays at the existing 3.35%.
The marginal standing facility rate and the bank rate remain unchanged at 4.25%. The reverse repo rate also stands unchanged at 3.35%.
This announcement is expected to be a boon for fixed deposit investors as banks have been continuously cutting rates on deposit for more than a year now. A pause in the repo rate reduction is likely to prompt banks to go easy on cutting fixed deposit rates. When the RBI opts for rate cuts, banks are expected to pass on the benefit to customers in the form of reduced interest rates on home loans, personal loans, vehicle loans, and other loans. The Monetary Policy announced relaxation of the loan-to-value ratio up to 90% for the gold loans, which should be a relief for households facing severe liquidity crunch due to loss of income. With gold prices witnessing a sharp increase in the last few months, the households with precious assets can expect to get much higher loan against their gold pledges.
As per extant guidelines, loans sanctioned by banks against pledge of gold ornaments and jewelry for non-agricultural purposes should not exceed 75% of the value of gold ornaments and jewelry. With a view to mitigating the impact of COVID-19 on households, it has been decided to increase the permissible loan to value, what they call LTV ratio, for such loans to 90%. This relaxation shall be available till 31st March 2021.
For new borrowers, a reduced repo rate signals good times ahead, as he can take a home loan even if the key policy rate is kept unchanged. Borrowers who have loan linked to an external benchmark are likely to continue to pay the same monthly installments. The factors that can now impact these installment payments are the margin charged by the bank over and above the external benchmark rate and the risk premium. Continuing its measures to tackle the COVID-induced fluctuations, the RBI has allowed a one-time restructuring of loans without classifying them as NPAs. An expert committee headed by former ICICI Bank CEO K.V. Kamath will be formed to suggest ways in which the restructuring will be implemented. The committee will also examine proposals for restructuring of the loan amounts higher than Rs 1500 crore. This committee will be responsible for checking and verifying all the processes have been followed without interfering with the judgments passed by lenders. The committee would be based out of Indian Banks Association, and the Reserve Bank shall duly bear all its expenses and running costs. Loan to micro and small enterprise will also be restructured up to an aggregated of Rs 25 crore per borrower. An additional liquidity window of Rs 5,000 crore each for the housing finance companies and NABARD has also been announced, which should provide some much needed relief to these sectors. Lending institutions need to frame policies to implement viable resolution plan for eligible borrowers under this framework. The policies shall provide details of the eligibility of borrowers and lay down the due diligence considerations to be followed by the lending institutions. Corporate restructuring may be carried out by converting a portion of the debt into equity.
The cost of borrowing for NBFC borrowers and non-NBFC borrowers have significantly come down, and the NBFC sector, which was in stress post ILFS throughout in the early part of 2019, have now access to funding at reasonable costs.
Likewise, other marketable and non-convertible debt securities issued by the borrower can also be used for this purpose. A restructuring framework for MSMEs in the standard default category is already in place. With COVID-19 continuing to impact normal functioning and cash flows, the stress in the MSME sector has increased.
The MPC noted that in India too, economic activity had started to recover from the lows of April and May. However, surges of fresh infections have forced reclamping of lockdowns in several cities and states. Consequently, several high-frequency indicators have leveled off.
Hence, it has been decided by the RBI that stressed MSMEs borrowers will now be eligible for restructuring their debt under the existing framework. The RBI seems to have risen to the occasion by announcing a restructure for stressed borrowers, helping lenders in the process. Industry bodies have been consistently advocating loan restructuring for long without compromising credit discipline, and today's measures are a step in the right direction. What, according to you, are the follow-up measures required in the policy framework to provide further relief to investors?